More on this story now. The latest figures will renew expectations that interest rates will rise soon. We can talk to Andrew Sentance, Senior Advisor to Cambridge Econometrics and a former member of the Bank of England's Monetary Policy Committee, which sets interest rates. Andrew, very good to have you with us as ever. Picking up then on what Andy Verity was saying, what are the tools that the Bank of England has to deal with inflation?
Well, I think the two obvious tools that they have are, one, the level of interest rates, and the second is the bond purchases that the bank makes from the government, which is called quantitative easing, which also helps to sort of oil the wheels of the economy. And I think in both senses, the settings that we have, where interest rates are set, and the quantitative easing that we've had, was set really for a very different type of economy to the one we're now experiencing. It was set for the pandemic and the lockdowns, and now we're moving out of that. We can see inflation is high, we can see the labour market is tightening. So it's not just for inflation that we need to reassess where interest rates should be. And they are, after all, at record low levels, and the quantitative easing is at a record high level. And hence monetary policy will need to be adjusted over some period of time.
So you think it's highly likely then, do you, that the Bank of England will put up interest rates at the next opportunity?
Well, whether it's at the next opportunity, I'm not quite sure, because that's only about less than 10 days before Christmas. And nobody on the Bank of England's Monetary Policy Committee wants to be accused of being Scrooge. But either at that meeting or in February, I would fully expect a small rise in interest rates to around about 0.25%. We have to remember that's a very low level of interest rates in historical terms. And over the course of next year, we should expect interest rates to go up to perhaps about 1% or even a bit higher by the time we get to the end of the year.
And Andy Verity posed the question, didn't he, if you were able to hear him, Andrew, if the Bank of England does indeed increase interest rates, is this actually going to have an effect on inflation, given the global factors, not so much the domestic factors behind that increase?
Well, first of all, we need to recognise that interest rates affect the economy with a delay, both in terms of the level of economic activity and in terms of inflation. So the Bank of England needs to be thinking ahead. But in their latest inflation report, they showed that even when the spike in inflation, which we're expecting, subsides, they would expect inflation to be stuck above the target, somewhere around about 2.7, 2.8%, even when some of these temporary factors have passed through. So the first thing is that, according to the bank's own analysis, they need to do something on interest rates to correct that. The second thing is that if the bank does nothing, then some of these global cost pressures will be intensified by the weakness of the pound. So they will be even greater because the pound is suffering on the foreign exchanges. So on both counts, I think interest rates would be some impact on inflation, but it won't happen immediately, and therefore the Bank of England need to think ahead.
So, Andrew, do you think this upward trend in inflation is for the short term, or is this something we're going to have to get used to over the longer term?
Well, the short-term outlook is for even higher inflation than we've got now. In my estimate, about between 5 and 6%, a peak in inflation sometime in the first half of next year. Some of the temporary factors will then wash out, but if we don't get some correction in interest rates and in monetary policy, I think the rise in inflation could be much more persistent, even though we might come off the peak. So that's the justification for actually raising interest rates, not in a dramatic way to shock the economy, but in a gradual way, so we get interest rates that are more attuned to where the economy is now, rather than where it was 6 to 9 months ago.
OK, Andrew, really good to have your expertise on this today. Andrew Sentance from Cambridge Econometrics. Thank you.